How to evaluate property investment opportunities abroad. Author, Dr.Pooyan Ghamari, Swiss economist. Investing in real estate abroad can be a lucrative and rewarding endeavor, offering diversification and potential for high returns. However, it requires careful analysis and a strategic approach to mitigate risks and maximize benefits. This guide explores the key factors to consider when evaluating property investment opportunities in foreign markets, ensuring well-informed decisions and successful investments. Understanding the market economic stability. Evaluate economic health. Before investing in any foreign property, it is crucial to assess the economic health of the target country. Look for indicators such as GDP growth, inflation rates, and unemployment levels. A stable and growing economy is often a sign of a healthy property market where values are likely to appreciate. Fiscal policies. Investigate the country's fiscal policies, including government spending and taxation. Countries with prudent fiscal management are less prone to economic disruptions that could negatively affect property investments. Political environment. Political stability. Examine the political stability of the country. Stable political conditions are essential for protecting property rights and ensuring investment security. Countries with frequent political unrest or unstable governments pose higher risks for investors. Regulatory environment. Understand the local regulatory environment governing property investments. This includes foreign ownership laws, property rights, and any restrictions that may apply to non-residents. A transparent and investor-friendly regulatory framework is crucial for safe investments. Legal framework. Property ownership laws. Familiarize yourself with the property ownership laws in the country. Ensure that the legal system provides robust protection for property rights and that you understand the process for purchasing property as a foreign investor. Contract enforcement. Evaluate the efficiency of the legal system in enforcing contracts and resolving disputes. Reliable legal mechanisms are vital for securing your investment and dealing with any issues that may arise. Market research. Property market trends. Analyze market trends. Study local property market trends, including price movements, rental yields, and occupancy rates. Consistent price growth and high rental yields are positive indicators of a healthy market. Utilize local real estate databases, market reports, and insights from local experts to gather accurate data. Economic drivers. Identify the key economic drivers that influence the property market, such as tourism, industry, and infrastructure projects. Understanding these drivers can help predict future demand and value trends. Supply and demand dynamics. Supply and demand analysis. Assess the balance between supply and demand in the local property market. High demand with limited supply typically leads to property value appreciation, while an oversupply can result in stagnant prices. Development pipeline. Investigate upcoming property developments in the area. A large number of new developments can affect market dynamics and impact property values. Location analysis. Prime locations. Evaluate the location of the property. Prime locations, such as city centers, business districts, and areas near major transportation hubs, generally offer higher appreciation potential and better rental yields. Neighborhood quality. Assess the quality of the neighborhood, including safety, cleanliness, and access to essential amenities like schools, hospitals, and shopping centers. High-quality neighborhoods attract long-term tenants and maintain higher property values. Financial considerations. Financing options. Explore financing. Investigate the financing options available to foreign investors. Compare mortgage rates, loan terms, and eligibility criteria. Some countries offer favorable financing options for foreign investors, while others may have more stringent requirements. Currency risk management. Be aware of the currency risk associated with foreign investments. Exchange rate fluctuations can impact your returns. Consider hedging strategies to mitigate this risk and consult financial experts for advice. Tax implications. Tax analysis. Understand the tax implications of investing in property abroad. This includes property taxes, capital gains taxes, and any tax treaties between your home country and the country of investment. Seek professional tax advice to ensure compliance and optimize your tax strategy. Tax incentives. Look for countries that offer tax incentives or benefits for foreign property investors, such as reduced tax rates or tax holidays. Due diligence property inspection. Thorough inspection. Conduct a comprehensive inspection of the property. If possible, visit the property in person or hire a local professional to do it on your behalf. Look for any structural issues, maintenance needs, and overall condition. A detailed inspection report can help you negotiate the purchase price and plan for future repairs. Compliance with standards. Verify that the property complies with local building standards and regulations. Ensuring compliance is essential to avoid legal issues and additional costs. Legal due diligence. Legal verification. Ensure that the property has clear title deeds and is free from legal disputes. Engage a local lawyer to verify the legal aspects and facilitate a smooth transaction. Clear title deeds are crucial for securing your investment. Regulatory compliance. Confirm that the property meets all local regulations and zoning laws. Market comparables. Comparable analysis. Compare the property with similar properties in the area. Check recent sale prices and rental rates to gauge whether the property is fairly priced. Use this information to make informed investment decisions. Historical data. Analyze historical data to understand long-term trends in property prices and rental yields. Risk management. Market entry and exit strategies. Strategic planning. Have a clear market entry and exit strategy. Understand the processes and costs associated with buying and selling property in the country. A well-defined strategy helps manage risks and ensures you can exit the market efficiently if needed. Optimal holding period. Determine the optimal holding period for your investment based on market conditions and your financial goals. Local partnerships. Build local partnerships. Consider partnering with local experts, such as real estate agents, property managers, and legal advisors. They can provide valuable insights and assist with navigating the local market. Local knowledge is crucial for identifying the best investment opportunities and avoiding pitfalls. Networking. Join local real estate networks and associations to stay informed about market developments and investment opportunities. Diversification. Diversify your portfolio. Diversify your investment portfolio to spread risk. Avoid putting all your capital into a single property or market. Diversification helps mitigate the impact of local market downturns and enhances portfolio stability. Ongoing risk assessment. Continuously assess the risks associated with your investments and adjust your strategy as needed. Evaluating property investment opportunities abroad requires a deep understanding of the local market, economic conditions, legal framework, and financial considerations. Conducting thorough market research, due diligence, and risk management allows investors to make well-informed decisions and optimize their returns. While investing in foreign real estate offers substantial benefits, such as portfolio diversification and exposure to high-growth markets, it is essential to approach it with caution and informed judgment. By recognizing the critical role of infrastructure, economic stability, and regulatory environments, investors can navigate the complexities of international real estate and achieve successful outcomes. Policymakers should prioritize creating a stable and transparent investment climate to attract foreign investors and foster sustainable economic growth.